Hello and welcome to Any Answers Answered for July 2024, recorded just before the general election, so anything that's changed, not our fault. As ever, we've picked two questions to have a look at, and Tim, we start this month with a question from Claudia Lowe, and the question is, which box to put transitional profit adjustments through? The answer, of course, is any number, depending on what's actually going on in your return. But the point here is, it's the only box that will adjust box 73 if I fill in box 68 and have the correct figure. However, the revenue says it's 68. If your basis period is not... Look, Tim, do you know what? Let's ignore the question and simply ask you, what boxes should we be filling in as far as the transitional adjustments are concerned?
Well, let me first answer the question. Which box to put transition profits adjustment ? But Claudia Lowe then goes on, that was the title to the question, more specifically to say, do you put the transition profit in box 68? And the answer to that is no. The correct box for putting the transition profits in, and it's not clear exactly what Claudia means by transition profits adjustment, but the transition profits themselves go in box 73.1. Now, I and many others now know that the HMRC system for reporting the 23-24 self-employment figures is counterintuitive, and the entries that we make and even the number of SA 103 forms, the self-employment forms that we have to submit, will depend on the accounting periods that we choose. And first, let's consider a simple scenario where the sole trader or partner has a 31st of March or equivalent 5th April year end and always has done. That's dead simple. There are no transition profits. There's just a 12-month accounting period ended in 23-4, and we just complete an SA 103 as per in previous years. But then what happens to all those non-coterminous traders? And of course, for there to be transition profit, you must be non-coterminous. So let's take our own example. Our partnership has a 31st December year end. So our transition profits will be the 3 months to the 31st of March or 5th April 24. And those, either on an estimated basis, or in our case, it'll be an actual basis, will go into box 73.1. However, we've then got to ask ourselves on which SA 103. And that'll depend on whether we decide to have a 15-month period to the 31st of March or 5th April, in which case we will only complete a single SA 103 and the transition profits will go into box 73.1, but also they will go in as a deduction in box 68 to ensure that we get to the right figure for the 12 months that the revenue will then report or display above the line on the SA 302. But if instead we were to decide to have 12 months to 31st December and then a 3-month account to the 31st of March, we would have to complete 2 SA 103s. The first, HMRC will call the main one, and that is for the accounting date that is the second date in the tax year. So that'll be the 3 months to 31st of March 24, and that'll all be transition profit. Whereas the second one, the supplementary SA 103, will be for the 12 months to the 31st December 23 for us, and that will simply report the profit for that period without any entries below, I think it's box 66, so no entries in 73.1 for transition profits. And at this point, I'll stop there because it just demonstrates how ludicrously complicated this whole thing is. And it's no surprise that software companies, our own included, have struggled to help agents and taxpayers in completing and coming up with the right answer.
I was going to say unnecessarily complicated, but of course, it is necessary to go through this complexity to get us into that position where the tax year basis can work for 24-25. We need to get there first. So hence we have to have this transitional profit and the spreading and everything else. My tip, I guess, is don't wait till January to start looking at this. The sooner, the better. Our second question, Tim, comes from PJN, who asks a double whammy question. close investment holding companies and associates. We have a client who is a 100% shareholder of two companies. A Limited is a trading company with profitable trade. B Limited owns a property which it rents on a commercial basis to A Limited. Now, the question we're really asking here is, we have two associated companies, so we're dividing bands, but a close investment holding company still pays at the main rate always. Is it two pieces of bad news?
Yes, the answer is yes, it is a double whammy, and it is a very unfortunate one where the two companies, the trading company A Limited and the property owning company B Limited, where they are not in a group, but they are under common control. Here, the client owns 100% of each company. Well, because they are associated, A Limited will only get half of the small profit thresholds, so only 25,000 at 19%, and then the taper relief up to the main rate threshold halved at 125,000. And so that will increase A's liability. Whereas in the property company B, yes, it does qualify as a close investment holding company and therefore is not eligible for small profits rate at all. And so although we do have the halving in A, B doesn't benefit from any of the small profit rate thresholds, hence the double whammy. But in some of the postings in response to this, at the time of recording, there were only 6 postings. There was a misunderstanding about whether it was a group, but yeah, the point is, if it is a group of companies, so if in fact the client who's the subject of this question, instead of holding 100% of A Limited and 100% of B Limited, if they were to introduce what I'll call a pure holding company, and that holding company owns the two 100% subsidiaries, then because there is an exemption from the close investment holding company legislation for a property company that is simply renting properties to other group companies, the problem would disappear. So where it's in a group situation, the intra-group letting of the property means that the property owning company in the group is not going to count as a CIHC, in which case we're still going to halve the thresholds. Halve, by the way, because my holding company is a pure holding company and therefore doesn't count. So we halve the thresholds in each of the two companies, and the property company would qualify for the small profits rate accordingly. But a further point that one of the other commentators made, Tax Dragon, was that if stopping the rent, I think there was a suggestion that B Limited should allow A Limited to occupy the property rent free, and that would make B Limited dormant. And then you could argue that as a dormant company, B Limited doesn't count as associated. And so we would increase A Limited's profits by the amount of the rent that B Limited was claiming, but we wouldn't then have a halving of the thresholds because B Limited is dormant. However, what Tax Dragon says is that this suggested solution to the problem may not work because simply stopping the rental invoices might not be sufficient to bring the property company's property business to an end. That's because A presumably continues to occupy the sister company's property on a commercially active lease, with perhaps A being responsible for outgoings in relation to the property. And that would mean even though B isn't collecting any rent, it's still going to count as an associated company with A and not solve the problem.
Isn't it wonderful? Every time we make tax simpler, we somehow seem to make it more complicated. That's all for this month. Hopefully useful to the people who asked the questions and many others besides. We don't make an August edition. We are taking a summer break, but we'll be back at the beginning of September. Until then, have a wonderful summer and we'll see you on the other side.